which is why when you talk to the endowments and the large allocators, and we're in the middle of doing a series with some of the world's largest wealth funds and allocators, is they have typically a strategic asset allocation. They have a framework, and they'll have accepted deviations from that, so that they don't wake up in a cold sweat one morning and decide to sell all of their equities and put it all into fixed income.
Well, thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, as always, Christian D. Evans. And guys, we have a very special guest on today. I'm very excited about having him on. He's a graduate from the London School of Economics with a degree in economic history, and subsequently took the advanced management program at INSEAD in France. He started his career at Citibank in 1985, where he trained as a portfolio manager before joining Morgan Stanley in 1989. Over the last 17 years there, he managed the global balanced portfolio, was a chairman of the European Asset Allocation Committee, and chief investment CIO. For the last 12 years, he was the CEO and owner of the Vantage Investment Advisory. In addition, he is the senior advisor to Rothschild in London and governor of Clifton College and chairman of the Development Trust, and served as the trustee of Great Ormond Street Hospital. He is currently also the host of the incredible, well-renowned Money Maze podcast, which has featured incredible guests like Michael Lewis, which is the best-selling author of Big Short, Sir Chris Hone, which is a billionaire hedge fund manager, and so many others. Please welcome my next guest, the one and only Simon Brewer. How are you doing today, Simon?
Christian, I've never had an introduction like that. It's fantastic. I think we should just stop the interview right now.
Well, man, I'm excited about having this conversation. And, what was so interesting is you're a very humble dude. I can tell right off the bat because of your experience and your incredible knowledge in this industry. And you've been a CIO for very large companies. You've also been the CEO for, obviously, your company currently. And I want to ask you this in regards to Simon. The young Simon, think about that young Simon that was just starting 1989, 1985, and 1990. You've been through a lot of ups and downs, right? A lot of turmoil industries. And now you're at this age where you're looking back at that history and you're looking at that young Simon. And I'm curious, Simon, what insecurities, what kind of things did you have to overcome to become the Simon that you are now?
So it seems many of your listeners will go, oh my God, he's that old. 1985 is the dark ages. Well, and somebody in fact sent me the Goldman Sachs recruitment video. It was a video of 1983, and they're all smoking cigarettes in this cloud of haze in the dealing rooms. It's like another world. And all I would say is that I've been extraordinarily lucky to be in this industry for all that time and work for some terrific firms. But I was absolutely clueless coming out of university. I mean, now we interview polished graduates from business schools. I mean, I was not alone. We did not have an idea. I mean, I went to the London School of Economics, and that was pretty miraculous getting in there. And, what paid best? Consultancies and investment banks. And Goldman's was hardly known. And I mean, I turned up at that interview at Goldman Sachs, which was in the spring of 1985. Two beautifully dressed, individuals come over from New York, and they sort of sat me down and said, Simon, what would you like to do at Goldman's? And I'd asked my flatmate the night before, and he'd given me what seemed like an absolutely excellent answer. And I said, I'd like to do portfolio management for high net worth individuals. And the guy looked at me and said, we don't do that. And I said, I'm very flexible. And the interview ended, and I didn't get a job at Goldman Sachs. So I have been incredibly lucky, but I would not for a second suggest that there was a master plan out there. It was like, who paid quite well? And in fact, I didn't get the job at Goldman Sachs. I interviewed alongside Michael Lewis, who you mentioned at Salomon Brothers, who did get the job exactly that year. And I joined Citibank, which I can tell you was exactly half the salary of the other two firms.
So when you're looking at, and because you've now interviewed quite incredible list of individuals, and you've obviously been in this industry and you've worked with some very well established firms. So how has your paradigm of investing changes, if it has?
Yes, I mean, I have been sort of learning to be an investor because it is a journey without a final destination. And one where the whole map, or if you like, the chessboard, had suddenly more pieces put on it, because when we started out in the mid-80s, private equity wasn't a conversation, listed real estate wasn't a conversation, hedge funds were, in their infancy. So it was stocks, bonds, cash, and foreign exchange if you sat outside of the US as another important component, and then gold, which we might come back to later in the conversation. I think that in the last few years, one can be cynical, or at least suggest that central banks have changed the game courtesy of zero interest rates, which persisted for way too long. But I have to say, interviewing so many smart people has just made me realize how little I know, and that when I'm asked about certain asset classes, there are some, like private equity, where it's very difficult to offer anything of value because it's just not an expertise I have. I tend to have worked in public markets, equity, bonds, currencies, done a lot of thinking about strategic and other asset allocations, but it's a complex world, and there are some really just fantastically smart people out there. Although, as we know, being fantastically smart doesn't lead to sustained returns.
So, and that makes sense in regards to, obviously you gravitate toward one, and I do find it interesting, the complexities of this industry has multiplied tremendously. There's a lot of alternative investing strategies, like you just mentioned, in regards to natural resources, and of course, private markets, which I find very interesting. Hedge funds were, like you just mentioned, in the infancies during that time. So have there been certain mental models that you have always leaned on during this evolution of your journey?
Well, I think it's probably not unusual that at some point you get air cover from somebody in a firm who really kind of helps you on your journey, and certainly I had that both at Citibank and at Morgan Stanley. And then the people who come along who influence you unless you are very clear at the start, certainly in terms of investment philosophy. And I think I found myself exposed to people who would fall under the value umbrella from an early stage. So one tended to be more sympathetic to to notions of value, and one knows the sort of the well-known value investors. But the problem about that is that this is a humbling business, and if you get too wedded to either a discipline or even a valuation approach, you can miss large parts of large cycles. And certainly I've learned that at my expense, that the need to be open-minded. If it's that cognitive dissonance, if all you read is research that supports your own views, then you're not really thinking. What was it was General Patton, wasn't it, the famous American general, who said in some discussion about the Second World War, if you're all thinking the same way, none of you is thinking. So, it's important to be challenged.
I definitely am a big believer in that, where it's, obviously iron sharpened iron in this concept. And so, Simon, if you're looking back at your journey, your own history, I would imagine there were probably certain pivotal moments in your life where maybe it was kind of a misstep and you had to learn from that experience, or there was a little bit of, hurt or a little pain or frustration a little bit, whether it's misstep of market, understanding, or, reading the data wrong or whatever, or the trajectory. I do know you have a degree in economic finance and history, and you've obviously looked at history, and we all know history repeats itself. And I want to ask, Simon, how do you approach it? Not as in regards to like what we see right now in the historical kind of cycle, but really, how do you approach it where it's like this methodology, these principles that you've established that, hey, it doesn't matter what cycle we're in right now, it's how you're able to identify that from looking at history. How does Simon look at it in a historical context to identify where we're in, the methodologies that you use, or the principles that you use?
Yes, I mean, there are various adaptations of the Mark Twain quotation, but I like Winston Churchill's, which is the further back you look, the further ahead you can see. And the value of that is because human behavior repeats itself. I mean, why did the powers that be in America and the US not stop when they went into Afghanistan, after the Iraq War, and just draw on the history lessons from powers that had failed? And so to expect exact parallels would be wrong, but to expect similarities shaped by human proclivity, particularly greed and fear, I think is instructive. Now, we've been through an extraordinary period, ushered in since the great financial crisis, the GFC, in 2007 and 8, when as the financial system seemed to be imploding, so central banks cut rates and then introduced what was previously unthinkable policies. Now, one can argue whether those were appropriate and right at the time. What I think is less debatable is for the length of time that those policies were kept in place, and in doing that created behaviours that are unhelpful in terms of money should have a proper price to it, and if you create too much free money you get malinvestment and you get consequences of that. And I guess the question, if you are looking back at previous histories, I suppose and I am doing that, it would lead me to think that it is unlikely we're going to simply have a short, painful rate tightening cycle, which was ushered in a year ago, and for the world to slow in a sort of an orderly way without more severe consequences in terms of economic activity and fallouts. So we had last year was an uncomfortable year, in the growth end of the spectrum, coming off an extraordinary year, the year before. But I guess my sense is that there's going to be a period ahead that won't look like the previous 20 years and may look like something that we saw in the 1970s, in some respects. When you think about the inflation debate, inflation is extremely difficult to predict. So I can sit here and give you numbers and sense, but in reality we don't know. But once it gets into the system and it gets into expectations, it's difficult to eradicate. So you have that, number one. You've had a tightening cycle that's still ongoing, number two. You've had this war, which is an exogenous force bringing in price rises, but of course that and COVID are forcing corporations to think about their supply lines. There is this friend-shoring or on-shoring or near-shoring. The reason these folks went away was to reach lower cost labour, and coming back they're going to be finding costs are higher, and that will it seems to me have an impact on margins, and margins are a mean reverting form. So I can see an environment that might persist for a long time. It might be a decade in which you have these cycles, but overall returns are lower, inflation is more sticky, and it's just a lot harder. And that culture of free money that has spawned all sorts of activities, including lots of stuff in private markets, just, I think, gets a lot more difficult.
Well, what I love about talking with people like yourself that have been through a lot of ups and downs in the market is you have experience, right? You have experience under your belt that other people like myself, I don't, right? I've never been through 2000. I mean, we have been 2000, but I don't remember it. I was young. But my point is that when you're looking at a company and they're kind of maybe looking to buy it, you're always looking at certain KPIs, and those KPIs, that data that you're gathering, tells a story. And you have to identify what that's telling that story within the last 5 years of, measurements or specific financials. But it's the same thing that I love about history a little bit. You're seeing these patterns that establish, right? And like you just mentioned, there are certain, KPIs or measurements that you're looking at and say, okay, well, we've been in this situation in the 1980s. There was this high inflation. There was a lot of interest rates. The interest rates are tremendous, much more in the 1980s, and here in the U.S. that was, compared to obviously now. And people are really, getting really frustrated with it. Well, the interest rates are really high, but the reality is compared to what, right? Compared to obviously 0%, sure, but also compared to 1980s, it's actually relatively low, right? In the U.S. that is. So what I always find interesting, Simon, is how individuals like yourself, you can look at the macro, but then also you're able to interpret this data on a real live basis from the experience that you've established, and you use some sort of KPIs, but also it's telling you a story and how you're interpreting it, and then how you can navigate it for future use as well. So with that being said, how is there a methodology? Is there a principle, like you mentioned, where there are certain KPIs, certain indexes that you're leveraging, you're identifying at a macro or a micro level, and say, okay, hey, we've seen this. Now this is the story it's telling me. This is kind of the picture. This is the foundation. This is where we're going and navigating it. So I'd love for you to just share kind of that whole macro or micro level that you're looking at this, global economy.
So, tough question, Christian. Thank you. I think that if one is looking at the map of building blocks that create a portfolio, one has those components: bonds, cash, stocks. Then you can move up into these higher risk categories. And each of those contains a set of investment parameters that might give you comfort. So you look at fixed income and you go, wow, I can get, 5% on a 2-year bond right now, happy days. But, if inflation persists at 7 or 6, it's a negative yield. It's better than it was when it was 0 and inflation was 3 or 4. So, fixed income's gone from being uninvestable to being potentially investable, but it may be that in looking back, one says, okay, where was the real damage done in the U.S. government bonds in that long post-war period when inflation kicked in, and the longest damage was done in longer duration. So if you are keeping short, you're giving yourself some more protection. Then you go, well, actually, one subcomponent is credit. Do I want to be going to credit? And we did have Greg Peters, who runs PGIM, a huge fixed income firm in the US, and I was very sympathetic when he said, I think it's still too early, because after all, corporate credit looks a lot like equity. And if you're getting worried about an economic cycle and earnings, etc. So part of the answer is you need to look at these building blocks relative to their own history and the factors that dictate. Equity investors love stories, which is why they ratchet onto a Tesla and they'll run it up until the valuation makes, to many of us, absolutely no sense. And you know what? If you map Tesla on Bitcoin, you get a chart that has quite a high correlation, and no surprise. Now, Tesla might be a lot more useful than Bitcoin, in my opinion, but nevertheless, there's a price for everything. And then you go into the equity universe, and I say that because equity investors like the story. Fixed income investors tend to prefer the numbers. So we, growing up in more of an equity culture, we used to look at the fixed income guys and think they were a bit nerdy, and they used to look at us and think we were full of all sorts of things. So, but then you come to the world of equities, and the US has had this extraordinary epoch of outperformance. It's 2/3 of the world stock markets, and many would have expected that over the last 2 decades, where there's been global growth from all quarters, their percentage of the world stock market capitalization would have declined. But the US was the father to these fantastic tech platform companies that we all know and came to be known as the FANGs, and they became sort of the darlings, and in many ways became the must-haves in the portfolio. But of course, if you're a global investor, which is sort of almost the luxury of not sitting in the US, is you go, well, hang on a second, we've got very different forces at work. Europe has been suffering for some time, with what we might call Eurosclerosis. One currency fits all, that creates problems, lack of productivity, lack of top-line growth, aging demographics. But then you cast your eyes across to Asia, and you go, hang on, it's an 8 billion population world, and we've got 2/3 of the world's population sitting over there. You have countries like Vietnam and the Philippines, each at 100 million. You've got countries of Indonesia, which is, the 3rd or 4th biggest country in the world, and we haven't even got to China and India. And you go, well, hang on, where's the growth? And, our lens, Peter Frankopan, who was a guest who wrote that beautiful book, The Silk Roads, made the comment that many of us in the West have our eyes stitched closed. And that, of course, is a little bit of a reflection of Western sense of superiority and history. But if you then say, well, hang on a second, you take the Hong Kong market, which, last time I looked at the data, over sort of 40 years, companies had a similar return on equity to the US, and yet its valuation has obviously plummeted. Now, some of that is because of genuine geopolitical concerns around China and where that may be going, but Asia is much bigger, than China. So then you're saying, well, it's not about whether I look at Tesla versus General Motors, it's about whether I look at allocating capital to some of those other markets that are at very different stages of their growth. And then on top of that, you can come to quite an interesting conversation about currencies, which is another thing altogether. And if Western central banks are intent on essentially debasing their currencies by printing more and more of them, then it's sort of almost a race to the bottom. And then you say, well, hang on a second, who wins that game? And then you go, well, hang on a second, who's been the best at that? And it's been the Swiss. So I've probably answered that, by walking around the park a bit, but lots of different assets, and the lens you apply, or I would apply, or I've learned to apply by people much smarter than me, is you need to look at those, sure, a global context is helpful, but you need to look at those relative to the metrics that are most appropriate.
No, that I appreciate you unpacking that, and I know that was a big question to unpack that, and you really did an excellent, elegant job at doing that, because I found that very interesting in regards to, like, we even see in the tech industry here in the U.S. where it had that massive spike, obviously that up to the right trajectory, and now it's kind of cooling off a little bit. Not saying that it's not still going to obviously have an uptick, but it's a really good context in regards to that industry. If you would have obviously got on that forefront several years back, you would have been on that forefront where you would have been able to hold on to that up to that right trajectory. That was that industry. We're seeing ESG very similar right now in regards to, like, we're seeing that a lot of tailwind behind that, a lot of trajectory, a lot of that, and so we'll see if it has that up to the right trajectory as well. So Simon, I want to ask in regards to when you're looking, when you've talked to incredible people, like I mentioned, billionaires to individuals that have been in this space that have, allocated a lot of capital, and have done very well for themselves. And with all the people that you have talked to, I know it's probably hard to isolate this, but I'd love to, unpack, like, what were some of the big moments on the podcast, the people that you've had interviewed, being able to rub up against some of the greats like yourself as well in the financial world that you have really, really appreciated in regards to the feedback or regards to some of the things that you learned from, networking and talking to some of those guests.
Well, in case any of my friends are listening to this, I have to correct you, Christian, because you said I'm one of the greats, and they will now be clicking off rapidly, going, "This guy's a fraud." That's me, not you. So I have spoken to greats, and I've just been a very lucky traveller on this road. Well, let's start with the worst. And the worst example I will give of podcasting and interviewing was I managed to secure Sir Ronald Cohen, who is very well known in Europe, less well known in the US, but he's sort of the father of venture capital investing, created this firm Apax, and has done a lot of work for G10 on impact investing in the last few years. And he was in Tel Aviv, and I was in Switzerland. I did this recording, and I remember coming down to my family who was staying in a hotel, and they were by the pool. They said, "How was the podcast?" And I said, "Well, I forgot to hit record." And that was after 1 hour. So that podcast, he was generous and gracious enough to give me another hour of his time, but that was a low point in podcast. But that really wasn't your question. Everybody's got an interesting story. There's that lovely expression, everybody should have a sign on their forehead which says, "Ask me a question and I'll tell you a story. I'm quite interesting." And the great thing about this podcasting medium is, you and I have had a conversation before this. I don't really know you, but it is quite disarming. The podcast interviewer, if they are good at their job, is able to unpack and find a lot more than you might expect if you're just sitting in a regular interview. And it is quite bizarre as a medium why it does that. The lessons that I've learned, and we are thinking about writing a book around the Money Maze podcast, drawing on some of those, just fantastic insights. And it would be difficult to bring them all together. But we did interview General Petraeus recently. So I spent my life carrying this little book around and writing down quotations. And one of the things that General Petraeus said is, "Luck is what happens when preparation meets opportunity." Now, that has been said before in various guises, but when you hear that people have been at the top of their game, he also said life is a competitive endeavor. You have to embrace that reality, and compete. Now, not everybody necessarily would like that, but a lot of people listening to your podcast will be quite competitive in nature. They will be trying to succeed or have succeeded in their inventions. So I think that in talking to the obvious, should we say, rock stars of life, like a General Petraeus, you get certain sort of almost expected thoughts and perspectives about discipline, leadership, collaboration. Then you get people like Michael Lewis, Michael Lewis, who is a master storyteller. And as I said, he and I were at the LSE together, and it took a lot of persistence finally to reconnect and to nail him down. And just what humor, what anecdotes, what insight. When he tells about the pandemic story that led to his book Premonition, it was the quality of the research. And I think that, again, for most of these people who have been very successful, it's not accidental. They may have been born with a lot of talent. I suspect that, again, it's that old perspiration versus inspiration, and lots of them are hard workers. I picked up that quotation by, I forget which great tennis player it was. It was that hard work beats talent when talent stops working hard. And I think that in most of these cases, these are dedicated folks who have done great things. Joan Solitaire, again from Blackstone, who runs their private markets division, passionate but very coherent and logical. And then there's a whole element of patience, because we're all in a hurry. We can't bear to have so much information around that we're clicking from one thing to another, and we're not. There's information, but it was T.S. Eliot who says, where is the knowledge and information? I might have got it the wrong way around, but you get so much stuff thrown at us. How often do we absolutely sit back and process it and learn from it? But I guess the three things that I have taken from 100 plus interviews are that those people who I have admired most have had some combination of tenacity, patience, willingness to be knocked back, and generally some good EQ to complement the IQ and the hard work.
So those are the things that you took away from interviewing hundreds upon hundreds of incredible leaders. I love that. I think that's just really interesting to hear that from someone like yourself that is rubbing against some of these greats. And like I mentioned, I would reiterate that you are one of the greats because you're able to facilitate those relationships. Simon, I want to ask you in regards to also, with that being said, and obviously you're a very humble individual, have you always approached investing at a macro, micro, equities, even the relationships that you have in a humble nature? Or has that always been kind of a learning thing that you had to establish throughout your journey?
Well, I think knowing one's limitations is really helpful. And you mentioned Sir Chris Hoon, who was a guest on the show, who runs TCI, one of the world's most successful hedge funds. I mean, when you listen to a person like that, you think, wow, that's just fantastic, intelligence. Pete Davis from Nasdaq. I never had that problem because I didn't think I was ever in their camp of sort of, brilliance. I think that I became a disciple of some of the greats and tried to absorb some of their lessons and learn, synthesize, adapt. I think intuition becomes, quite an important component in the investing process. I look at charts a lot. So if we were to sit here, and wanted to talk about the Swiss franc, the first thing I'd want to do is I'd want to reach to a chart and show you, the Swiss franc against the dollar or against sterling over 30 years. Historical perspective, what were the lessons? Why did, and I'm going to quote it in sterling, but you can take the dollar, sterling. So sterling, the dollar is 1.18 today, but it was 4.5, around the time end of the Second World War. And a pound buys you just over 1 Swiss franc. Go back to 1969 and it bought you 12 francs. When you run high inflation and high deficits, you disembowel the currency over time relative to countries that do a better job of not running those deficits and not having persistent inflation. So I think that really I've learned from others, smarter people along the way, and that is, and where I've made my investing mistakes, of which there have been many, it's probably where I have sort of, believed too much in the certainty of an outcome. You take the great financial crisis, it came along, I was at a hedge fund which had survived that GFC extremely well, came out of it, and sort of in the 2016 sort of time, we kind of thought, that's enough. Markets have run this cheap money. It's got to end badly. You started, hedging up and therefore being less of a participant in the market. The market keeps on going, and the market, makes fools of us all. So I think learning not to be too inflexible and too obdurate is being really important. And you listen to Jeremy Grantham at GMO, obviously one of the great investors, and people might say, well, my gosh, up until last year you've been wrong for a decade, and that's a little bit of the problem. It's that whole successful investing is a minority sport. It's hard to consistently crank out the numbers. So humility, flexibility, but you've got to have some anchoring point as well. You've got to have some sense of where your stake has been driven into the ground in terms of how far you're happy to go away in one direction or another from that. Which is why when you talk to the endowments and the large allocators, and we're in the middle of doing a series with some of the world's largest wealth funds and allocators, is they have typically a strategic asset allocation. They have a framework, and they'll have accepted deviations from that, so that they don't wake up in a cold sweat one morning and decide to sell all of their equities and put it all into fixed income.
Well, see, and this is why I love this conversation, because I think it's so interesting. Ray Dalio really, and you just mentioned this as well, where Ray Dalio was mentioning, obviously, the U.S. went off the gold standard, and he thought the market would tank, when the reality of the market, what did it do? It just went up. It didn't really make any sense, right, logically. But then that's where, human psychology or human behavior in the market, it's almost conflicting a little bit. So this is what I'm going to ask you in regards to your approach from your history of investing. You mentioned you've invested something and you're like, you know what, 100%, this is it. All the indicators are green. It's looking good. But in the market, for some reason, whether it's political influence, whether it's geopolitical, whether it's whatever, something you can't control, tells the market to go this way, and it doesn't make any sense at all. Simon, logically, because we understand that human biases, and obviously there's a lot of psychologists that have done a lot of research and a lot of research on this topic, where nobody likes to take a loss, 100% sure loss, right? We'd rather say I'm 100% right and just go in. So with that being said, knowing your own biases, Simon, how do you, when you know you're wrong, how do you ensure you put the right boundaries or systems or a stop loss to mitigate that risk in case that you don't, obviously lose your shirt? Like you mentioned, endowments don't just put everything in it, or like crypto or whatever it may be. We may see all these up to the right trajectories, but sometimes the market, obviously, for whatever external reason we can't control, all the indicators could say one thing, and then the market decides to do something totally different, and it doesn't make any logical sense. So what indicators or what boundaries do you put in play whenever you have an investment thesis or investment strategy to ensure that you mitigate that risk?
Well, there is an expression that is relevant here, which is that we as investors, given that we are frail individuals, have a habit, to use gardening analogy, of watering our weeds and pruning our roses. And that, of course, in a portfolio context means that we're reluctant to cut the losers, because two things happen when you cut a loser. You realize the loss and you're wrong, and the numbers have told you that, and whether it's to yourself or to your colleagues, and we hate that because because we're smart, we're investors, we're kings of the universe. And of course, that's just not the way it is. So I think that you come down to some basic principles, as if your allocation is so large to something that it is keeping you up at night, clearly got the wrong allocation. So discipline is absolutely key. And I'm a great believer in, now I'm not a baseball person, I'm a cricket person. We talk about, taking singles rather than sort of hitting the ball out of the park. I'm mixing my sporting analogies here, i.e. I think making money over time is about lots of small decisions that, that on balance turn out to be right, rather than swinging for the fences and occasionally you get a big, but you expose yourself. So discipline is really important. And discipline comes in two contexts. Number one, how much are you going to allocate to an asset class that is sensible, and if things really unwind, you won't get unstuck, because if you get up, you want to stay on the pitch. That is absolutely key. If you get taken out because you've taken too much risk, that's bad. And one of the reasons people do get taken out is they use leverage. So, lots of people listening to this will say, but leverage is used in certain contexts. Well, of course, it is used in all sorts of contexts, but at a portfolio level, leverage cuts both ways. And, bad stuff happens when leverage works, against you. So you've got a framework to suggest boundaries. You need to be, and I don't see why typically you should be using leverage at all in a portfolio, context. And that diversification was always referred to, as the only free lunch in investing. I interviewed the head of Mercer's investing consulting yesterday, and she said she actually thought the only free lunch was governance, as in the G in E, S, and G. Still got to think about that, but that makes it does make some sense for me. But it is finally knowing that if certain things eventuate, that you weren't expecting, there is either an event or a price limit or something that will determine an action. And the really good hedge funds, for example, who are using leverage in many cases and have large and concentrated positions, and for whom, of course, if you are allocated, and I do allocate to several hedge funds myself, you know why you've made that allocation and you know how much you've made to the allocation. So although they're using leverage, it's within a context. They are often some of the best at cutting their positions, recognizing their losses, and actually being just clinical, brutal and unemotional. And that's a great thing, because if you think about those polarities that we suffer from, greed and fear, we're typically drawn to act by doing the wrong thing at the wrong time, and that just repeats itself over and over again, and it is so difficult, and the great investors typically fight against that, etc. But that's why you need those disciplines in place, and that the cutting of a bad position, as in taking your losses, can be right, and you don't always have to make your money back in the same thing that you lost it in. So one has to remain open-minded, not be emotionally attached, and that's a little bit of the problem. There was a well-known UK fund manager who was a huge supporter of this German company Wirecard. Now Wirecard turned out to be a fraud, but there were pronouncements regularly from him and others that this was a great company, etc. But there was an old adage from a very brilliant lady called Louise Yamada, who used to be at Salomon Smith Barney, and she said, "In price there is knowledge." And sometimes, just sometimes, the market is telling you something and does give you time. Why is, remember Cisco, when we go back, Cisco was, the great switching company up into the, as the internet exploded, Cisco was at the absolute heart of it. And yet there was a time when stocks started not to go up as much on good news and started to fail, and there is this discounting process. So one has to be sensitive and sensible.
I love your thesis in regards to how you approach that, because it is a very methodical way, and like you mentioned, working and having the right boundaries and the systems, but also laying that out to say, hey, you know what? And then that's where the humility comes into play, where you know what you know and what you don't know, and acknowledging the both, and then obviously building the right boundaries and systems to ensure that. But like you mentioned, being surgical with it, saying, hey, you know what? My emotions are not in it. These are the systems. This is what we associated with it, and that's how we're going to deploy capital. I want to ask in regards to, you are big, and your experience comes from the commodity side of world, where you've done a lot of investing in that thesis, and gold and uranium right now specifically, because it is very interesting. And like you mentioned, I love that approach where that's where diversification is very important, because you're not putting all your eggs in one basket. You're putting your assets into non-correlated things, right? So that obviously if one tanks, that's okay. If something rocks and roll, obviously you want that to kind of balance out a little bit. So with that being said, in the back of your history with the commodity side of the world, what are you seeing right now in regards to gold, uranium, specifically in regards to asset classes?
Okay, how long have we got? I think that I'm going to, if you'll allow me, be a little particular and say to you that gold is not a commodity. One of the most attractive things about gold is that it is not, its demand and supply is not influenced by the financial cycle. Oil is a commodity. It responds to demand factors that are obvious. One of the reasons I own gold is an important part of my allocation, has been for a very long time, is that I am just inherently untrusting of the central banks, who continue to print more and more of their currencies, and they lose purchasing power. You don't buy gold because you think it's going to be, go up a multiple of, any number of, like you might buy a stock. What you're asking gold to do is to preserve the purchasing power, and over long periods of history, that's what gold has done. There's a very nice analogy of a gold sovereign and what it can buy you at the Savoy for lunch in terms of a bottle of wine and lunch. And gold sovereign can do what it did 100 years ago, for example. Now they're cycled. Gold can get ahead of itself and get behind itself. But so I'm just going to. I didn't want to be pernickety, but you own gold as a currency, in my view, and you view it not as a commodity, but something that gives you protection from the ravages of inflation and bad behavior by central banks, because paper currency regimes don't persist. But, okay, so I'm going to park that there, Christian. I'm going to come to commodities. I think that in this shift to clean energy, a greener world, a reduction in fossil fuels, there are a couple of points I'd make. By and large, I think politicians are being way too ambitious about the timelines. Okay, but we'll just park that for now. But if we then say, because 85% of the world's energy is still provided by fossil fuels, and you've had a depletion of investment, and hey presto, what have you got? You've got, not enough supply, not enough investment, and, well, I wouldn't be surprised if after a correction that may be sort of going on, the oil price ends up a lot higher, and the gas price. But in solving for the energy transition, I think a really interesting discussion is, who and what wins? Now, there's no single silver bullet to solve the solution for powering the world's needs for energy. I think it's going to come from multiple sources. And we know the environmentally friendly and the absolute, importance of solar. We understand gas. We understand wind. We understand some of the temporary and intermittent nature of those as well. But it strikes me that uranium, which had a crushing bear market, with huge oversupply, some of it coming out of decommissioned nuclear weapons, has reached an inflection point. There's been some great work done by firms like Sprott, listed company, obviously the listed asset manager, who actually have a separately listed uranium ETF, and I think it forms part of quite a nice way of looking at how that works out. Some of these energy companies are at the forefront of change, and they have fantastic balance sheets and big cash flows and own dominant positions. So I've liked those for a while, and some of them, Shell, BP, for example, in the UK, have been working very hard in this energy transition, or are going to be big investors. RWE, which was a dirty German coal company, is again sort of making that transition, and investors have had to grapple with, do they want to be with a company in transition, or do they not want to? And if they don't want to, who are they selling their shares to, and how are they helping? Because if they're then not having a robust discussion with the management, who are they serving? But we'll park that as well for the moment. And then you go, well, what's really interesting is if you're going to put up more wind towers and charging stations and all of the stuff that is going to go with the energy transition and this development, and we're not even talking about the rebuild of Ukraine, which will be an extraordinary event, you know what? You're going to dig up a lot of stuff that people are. Some will say, "Oh, this isn't very nice." Well, you know what? How are you going to get the copper out of the ground and into the machinery, and how are you going to get the steel for the wind towers? So I actually am quite persuaded by the argument that there is a really interesting secular boom, out there for a number of these commodities. And I, as an investor, I want to have exposure to that, because I think that's how you solve for this particular part of the the energy transition. So that's again maybe a slightly long argument. Gold is a separate story. Preservation of purchasing power. Uranium is just one part of the energy equation, and I think the energy configuration will evolve quite interestingly, and I happen to be persuaded that uranium could play quite a useful
So I
role.
like your approach in regards to using gold as a hedge, right, and just kind of reframing that the way to approach gold and your guys' strategy in regards to your investment side of things. So that's a really important kind of allocation and differentiation. Now, in regards to the commodity side of things, and specifically in the energy, I'm glad we kind of went this way. I find this very interesting because this is a really good example, the ESG world, where the logic and the emotion, it's kind of like it's a conflicting situation, because the logic is saying, well, there's still a lot of reliance on natural resources, natural gas, and yes, there's still a lot of opportunity with the ESG, but there's been a lot of subsidized by the government, specifically here in the U.S. to really infuse a lot of capital in that, and we've seen a lot of infused capital in this industry, but we haven't seen the results or the output of energy as much as obviously natural resources. It's still obviously definitely here in the U.S. I can't talk outside of the U.S. that is, but that's what we're noticing. And so, though what you're basically saying, Simon, I don't want to put words in your mouth, but what you're saying is that even though it hasn't got there in regards to the ESG world, in regards to the output of energy, like natural resources, it still means that you still want to have exposure in this, because at some point we know in a specific timeline that we really can't put a stamp on. We know at some point it will match the natural resources. Is that correct in regards to how you're thinking? You want exposure to this ecosystem or an investment thesis because you do understand at some point it will match the output of energy that natural resources has.
Yes, there are probably two levels to the decision making that I went through as I tried to process what was a collapse in the oil price during COVID. In fact, the futures contract went negative at one stage, and most of us never thought we'd see oil go negative, and then some of the smart operators started buying up the tankers and storing the oil offshore, etc. So I think there are two dimensions to it. The world was going to, we had this unimaginable situation where both the supply side and the demand side of Western economies was shut down. All economies essentially for a while, with all of the attendant consequences. But the world was going to start again, and the consumption of energy would feature large, and population would drive that, and et cetera, et cetera. So then you had that as your map. Okay, the world resumes, but with an urgency to recognise climate change and the need for reduction in carbon emissions, etc. So it was to say, well, what's a realistic timeline, and how do you want to participate in that? Because you'd had valuations be absolutely crushed. So the big oil stocks had been taken down for reasons of collapsing profitability and the whole movement against these big dirty energy companies. Many of whom, as I said, like BP and others, were actually trying to do something. Now, you've had a big re-rating of these companies from there. So at one level, in a portfolio, in an investor context, was going, hang on, huge part of the market, I'm going to get this slightly wrong, but let's just say at its peak, oil energy stocks might have been 20% of the S&P, and they went to 4. At the very time, the FANGs had gone from next to nothing to 25% of the S&P, and they are down at 20. So you get those extremes. Always difficult to pick. You get those extremes. So the contrarian in me was going, well, hang on a second. These are companies with long history, big balance sheets, huge cash flows. They can metamorphosize as well. So that was one of. But also, there's going to be absolute evolution in that space towards newer sources of energy. But what's going to be underpinning them? Who's making the picks and shovels? To help support the extraction. And then you go, well, hang on a second, there's a whole subset of the mining industry here that's going to, arguably be very well placed. And then you look at the EV, and we know what happened to some of the EV manufacturers, but the battery components, and so I think what the really good investors that I've observed over the years have been able to process the second and third order consequences and where that might create opportunities. So, I don't know what the timeline's going to be, but I think it's going to be much longer than governments have hoped, and that's not unreasonable. Governments are unreasonable, in their expectations, and they are happy to sign up to great pledges, and they won't be around when those time periods come. So, but I do think the investing landscape is quite interesting, because you can play it through old energy, but you can also play it through newer energies. But as you go into the newer component, you're dealing with, as you've alluded, cash flows that aren't there yet in many cases. These are businesses that are being developed. So again, you have to skew your investments depending on your timeline. But for most investors, there's always, it's well documented, an excitement around new technologies and new businesses, and therefore a propensity to put money into these things. But building new businesses is damn hard. So one has to just make sure that you're not carried away with the story, which can be financially very damaging.
So you have to take things at face value, and you have to gather that right data, and then interpret that data according to obviously what's actually truly happening, and not get too involved, at a geopolitical world. Yes, it sounds good, zero emissions, carbon, all that stuff, right? Eradicating all that. However, though, we also have to have a realistic view in regards to, okay, what is our approach strategically, because we still need that energy. So that's awesome. When you're, Simon, because you obviously have worked with some very well-known organizations and companies and people, and I'm curious in regards to when you're working at a macro level and political world, and how sometimes that doesn't align with maybe the indicators, and this kind of comes along with the market a little bit, with behavior and psychology a little bit, but specifically talking about politics. And the reason why I'm bringing this up is because ESG is a really good example of, it's a very good political headline. It's very sexy, ESG. We talk about it, zero emissions, all that fun stuff. But like we just kind of, laid out a little bit in regards to the foundation, the realistic side of things is, well, we still may need to obviously have both of these parallels and natural resources in the ESG run at the same time while we're figuring this out and, finding that balance act. We can't just cut off one umbilical cord and then hopefully, survive off one. So I'm curious in regards to your investment strategy. Okay, how politics and geopolitics, do you emphasize that much when you're looking at the macros and these indicators in your investing thesis? How do you approach that in regards to bringing some of that in and anticipating some of the unexpected or uncertainty investing?
Well, I think everybody loves to talk macro because it makes them sound more intelligent, and the higher level conversations about politics and direction, that's it sounds good, but I think it's a significantly less use practically at a portfolio level, because things happen that you didn't expect. Things take longer to materialize than many would have have thought, and it's a little bit looking like the GDP numbers of a fast-growing, economy. You might go, well, that's going to be great for the stock market, but often it isn't. They've proven that, in fact, quite low correlations between economic growth and stock market stock market growth. So I think you should take much more notice of what has happened and is happening, in terms of price discovery. A lot of those Asian markets were derated. I'm talking about the stock markets were derated because COVID hit them particularly hard. There was a disaffection with Asia. What always happens, hit a crisis, money comes home, people sell what they sell what they can, and then you have the evident illiquidity in some of those smaller markets always. So I think that one has to be very careful about extrapolating geopolitical thoughts, ideas, and firmly held views, because you just take one. Let's take China. We had Neil Ferguson on the show. He's at the Hoover Institute, one of the brightest men around, saying be careful when you own China, because their geopolitical orientation is not that of the West, and we could find ourselves or you could come in as investors having found unwelcome developments, perhaps regards it with Taiwan or somewhere else, and then you've got to really know why you own this. Now, that of course could lead you very simply to say, well, I don't need to bother, I don't need to ever invest any money there. But we don't know that in fact a coexistence between the Chinese and the Americans is achieved despite political philosophies that are diametrically opposed, and that the great companies like Tencent and Alibaba and others don't prosper, and after severe bear markets aren't magnificent stocks to invest in. But how much do you want to allocate? How do you want to, over what time frame? What's your risk tolerance? So, the geopolitical, we can always, it's the old adage, is that, if you're always worrying about, a nuclear strike or about the next pandemic, then you wouldn't invest any money, and that's the road to ruin as well, because, and I didn't say that earlier on, Christian, going back to the purchasing power, the number that others have produced is that the dollar has lost 99% of its purchasing power in the last 100 plus years.
See, one of the things that I get excited about is talking to people like yourself, because when I'm able to talk to people like yourself, you guys look at the market in a flexible way. And what I love about this is, as things evolve, as things adjust, as uncertainty establishes and creates a little bit of certainty, you're starting to see the interest rates. Okay, cool, wonderful. Well, you just pivot, and you are very flexible in the way you guys approach, and you look at the constant change in the landscape. And that comes with years of experience, with years of knowledge, with years of certain patterns, and you filter all that through, and it develops a certain story. And and that's what I was my hope. And really, Simon, I really appreciate you just sharing your methodology, the way you look at the never-ending, never-changing world of finance and investing, and these macro and micro level side of things. Because, like you mentioned, as the data is coming in, you have to interpret that data really on the fly and in a very flexible manner. And so, if like you're wrong, you got to cut that loss, move forward, and pivot, and really, make sure you obviously remove your emotions and go with the market and identify where the market's coming from. And Simon, you really I really appreciate you being on and sharing your methodology, your principles, how you look at it. And I know you've had many years of experience in the economic, historical financial side of things, and how you can obviously leverage and lean on that information, those patterns, to obviously with your future thought processes and the way you think about it in a macro and a micro level. For those that want to reach out to you, Simon, and consume more of your content and your incredible value that you have out there, how do they reach out to you and be part of what you got going on, Simon?
Well, I would say that one of the most exciting and fortunate things is that sort of the team, my partner Will Campion and my colleague Oliver Bodmer, here at the Money Mix podcast, and we're just about to add to another person to the team. We get to interview so many interesting people that when we've sponsored 5 or 6 universities in the UK to help promote dialogue with young people thinking about sort of the workplace and finance and when people say, what do you think about this, that, or the other? How should I gain more knowledge? And we go, well, look, there are 100 interviews on our website and they're free. And if you want to look at real estate or you want to look at private equity or venture capital, you've got the leading people from these firms. It's not about me. It's my job. It's just simply to ask hopefully ask a decent question and get out of the way. And then you can listen to people, give their thoughts and perspectives. And that's just fantastically valuable. So we would typically say, hopefully you could edit the dropped headphones out of that. We would typically say to folks, go have a look at our website. There's a treasure trove of stuff that's on there and continues to be on there because we're about to release a series on the sovereign wealth funds. Who would have thought that Culsters has such a different approach from Ontario Teachers, who has such a different approach to the Australia Future Fund? And that's about passive versus active, that's about hedge funds, no hedge funds, that's about, private equity. Extraordinary. So that's a great place to start, the moneymixpodcast.com, and then we have, we do have email addresses on there, and, we love people when they come up with, interesting ideas, and we have limitations on our bandwidth, but we've developed, I think to our delight, a really important group of listeners in the US. I think that our listener numbers, certainly they're over 25% of our global audience now is in the US, which is great because there's always such interesting and fantastic stuff that comes out of the US, such great thinking, great firms, Europe has still, and that includes the UK, Europe has much to learn about US dynamism, entrepreneurial spirit, lack of stigma with failure, the belief in the possible, and that's why I felt I worked for American firms for most of my life. I felt very, very lucky.
Awesome. And guys, those links are in the description below, so make sure you stop what you're doing. It is moneymazepodcast.com. I'll put that link in the description. There's a ton of amazing content. I would tell you that. Simon, as a host, he asks a lot of great questions for those guests, and you're able to unpack and unleash a lot of different strategies, the way they think, the way they process things, the way they look at things in regards to different market approaches and different investment industries. So I would highly recommend taking a look at that. And Simon, I really appreciate you being on here again. Just humbled by your spirit, but also the way you are able to ask these questions, get incredible immense value from each one of your guests, but also just the value that you brought today, talking about your thesis, talking about the way you think about it, your mental models, if you will, and your biases that you're aware of, to be able to ensure that, of course, hey, you know what, cut the loss when necessary, and be very surgical in your approach in industry, but also run with the market and acknowledge it, and gather all the data and interpret that data accordingly. And I always like to ask my guests before I let you go fully, is there any last words of wisdom, Simon, that you'd like to share with our audience?
There's no substitute for combining enthusiasm with hard work.
Well said. Well said. Gosh, that is amazing, amazing words of wisdom. Guys, that is my friend, the podcast host, CEO and CIO, my friend of Money Maze podcast, the one and only Simon Brewer. Guys, that is Journey with Christian Evans podcast. Until next time, be uncommon if you can.